Hello everyone, welcome to the third video of me learning how to trade using Forex. So just as a recap, in the last video we finished off reading the Investopedia page about how to Forex definition, how to trade currencies and examples. So we finished off writing our notes for that one. We then started looking at the IG page of what is Forex and how does it work. We made some brief notes on that, and we're just carrying on from yesterday now. So yeah. So I think this is the bit where we got up to uh, okay, yeah, the time bit, the European time zones and stuff. So we're on to this bit now. Learn how currency markets work. What moves the Forex market? The Forex market is made of currencies from all over the world, which can make exchange rate predictions difficult. As there are many forms, that said, the following factors have a small effect on our supply and demand. So, factors which move the forex market include supply and demand. Exchange rates for forex pairs are based on the supply and demand of one currency versus another. In basic terms, if demand for one currency is greater than the other, then the price of the first currency will rise against the second. The below factors all feed into what influences supply and demand. Supply and demand, so because the currencies are traded in pairs, if one of the currency is in a higher demand than the other, then the high demand one is going to be worth more, isn't it? Then the price of the first currency is going to be more than the second currency. The below factors all feed into what influences supply and demand. Central banks. A currency supply is controlled by central banks who can announce measures that will have a significant effect on that currency's price. Central banks choose the interest rates. Typically when change chooses in the country's currency may rise. Okay, so a currency's worth, I guess, or supply, is controlled by the central banks. Central banks can decide to increase or decrease interest rates. So if the interest rate rises, then the country's currency may increase in value. So if the interest rate rises, the country's currency value may also increase. Therefore, this is because it attracts foreign investors who want to benefit from higher interest rates. This is because it attracts foreign investors who want to benefit from higher interest rates. Oh, okay. This is because you would want to put more money into that bank because the interest rates are higher. Okay, this is because more foreign investors will be interested due to higher interest rates. Quantitative easing, meanwhile, involves injecting more money into an economy and can cause the currency's price to fall in line with increased supply. Quantitative easing, meanwhile, involves injecting more money into the economy and can cause the currency's price to fall in line with increased supply. So, the more there is of the currency, then the currency's price is going to decrease because there's more of it, so it's less rare. Is that sort of what they're saying? Quantitative easing. Quantitative easing involves injecting more money. Into an economy, therefore increasing the supply, which causes a currency's price to fall. Interest rates and carry trades. One of the more popular investments among institutional investors is called a carry trade, based on interest rate differentials between countries. So basically, if one country is offering a higher or lower interest than another country, this involves selling a currency with a low interest rate with a goal of using proceeds to buy a currency with a high interest rate. This aims to capture the difference in interest rates. Okay. Carry trade. Is based on interest differentials between countries. This involves selling the low interest rate, right? This involves selling a currency with a low interest rate and using it to buy a currency with a higher interest rate. This aims to catch the difference in the rates. So if you're selling the currency with a low interest rate, and then you can put the money back into a country with a higher interest rate to try to have an increase in the value of the money. Fiscal policy. Fiscal policy is how governments influence the levels of an allocation of taxes and public spending. This is how governments influence the levels and allocations of taxes. For example, high debt ratio and low growth is likely to be sold off. Perfect may instead provide a country with lower debt and high growth. Right, okay. High debt ratio. International trade. Both anticipated and actual international trade between countries also influences FX prices. For example, currency from a country with a trade deficit could be worth less than one with a trade surplus. This is because a country with a trade deficit imports more goods and services than it exports, then therefore needs to buy the currencies of trading partners to pay for these imports. Oh, right, okay, so international trade. Should I have fiscal policy? Oh, we'll need to know that now actually. Fiscal policy is how government influences the levels and allocations of taxes and public spending. a currency of a country with high debt ratio and low or low growth is likely to be sold off. FX trading may instead prefer buying currency with lower debt and higher growth. Right, okay. International trades, both anticipate and actual. For example, international trades. A currency market, a currency from a country with a trade deficit might be worth less than, could be less than a country with a trade surplus. This is because so they will need to import more goods, so they will need to sell more of their currency to buy the country they're buying the goods from. So if they're selling more of their currency, then it's going to be worth less because it's not as valuable as the other country's currency which they're buying the stuff from. Right, okay, so can be worth on a trade surplus. Trade country imports more goods and services than it exports. Therefore, they will need to buy the currency of its trading partner to pay for these imports. News reports and market sentiment. Commercial banks and other investors tend to want to put their capital into economies that have strong outlook. True? So if a positive piece of news hits the market about a certain region will encourage investment and increase demand for that. Then the might. This is why currency tends to reflect economic health. Interesting. So commercial. I wouldn't say this. Economies with a strong economic future, with a strong outlook, is more attractive for investors. So if a piece of a positive news will encourage investment and demand. If a piece of positive news hits the market regarding a certain region, then it will encourage investment, then it will encourage investment and increase demand for that region's currency. If it's negative news, then the demand might fall. This is why currencies tend to reflect the economic health of the region they represent. Market sentiment, which often reacts to the news, can also play a major role in driving. If traders believe that currency is headed so, they will trade accordingly, may convince others follow suit, increasing or decreasing demand. Oh, okay, so this is how other traders affect each other then. Market sentiment, which often reacts to the news, can play a major role in driving, which often is how one trader might affect other traders due to various news. Might convince to follow, which might increase or decrease demand. How to become a Forex trader? Learn ways are several, including trading spots, Forex for current media traders. You pair Forex. Right, so a Forex broker Right, okay. So a Forex broker provides the access to trading platforms which can be used to buy and sell currencies. It's the access of trading platforms which can be used to buy and sell currency. Charge a fee usually in form of a spread. Sell slightly, but right, okay. This new Forex broker would buy and sell currency, but with the right we can buy rather than exchange like stocks. Hmm. True. Interesting. This is very interesting. Stop loss orders. So this is important. You will also need to be familiar with what moves the forex market, central bank announcement, news reports, and market sentiment. Hmm. Right, interesting. So this is a good link. This is. Let's paste this in. What is forex and how does it work? Do that. Cool. Put that there. Right. Okay. Picture format. Let's do 50. Right. Okay. Cool. Cool. So next web page. Baby Pips School of Learn Forex. What is Forex trading? Learn to trade. What is Forex trading? Forbes. What is Forex trading? This. Let's go through the official Forex account because I remember there was a an academy, wasn't there? Yes, there is. Education. Develop trading skills for rocks. Okay, so I think this is what I will need to do. So I want to get through. Where is the start of this course? See all courses. Courses. Introduction to financial markets. Of course, start here if you're new to the markets. I think that's me. Introduction to financial markets. Welcome to Forex.com. Let's get started. Very good. What are financial markets? Financial markets are people, companies. So this is from. Let's make a new list. Where is this called? Source name. This is the official Forex.com page name. This is called Introduction to Financial Markets. Introduction to 0401 2024. Right, let's see. Welcome to Forex.com. What are financial markets? Financial markets are how people and companies buy and sell assets. Financial markets are how companies and people buy and sell assets. Oh, so include these are assets, so shares, indices, currencies, commodity, and more. I should start making a what's it called, like a dictionary thing, shouldn't I? Just like explaining what some of these keywords mean. So shares, indices, currencies, commodities. Yeah, I should do that. Let me make a note to myself. So no, new comment. Make a vocab list. There we go. Vocab list on what each of these words to the right, to the left mean. That's a to-do thing right there. More people have traded financial markets 100 years. They grow and practical need help people buy and help companies. You can speculate, I'm sure, such as lean hogs, changes interest in how there are a handful of assets classes that some traders stick to. Shares, also known as equity or stocks. Oh, right, here's a vocab. When you trade equities, you are investing in an individual company that is listed on a stock exchange. Famous examples include Apple, BP, or Microsoft. Ah, right, okay. Indices. An index tracks the price of a group of shares. For example, the S&P 500, one of the most widely traded indices globally, is a measure of some of the largest listed companies in the US. Interesting. So, shares, which is also known as equities or stocks. When trading equities, you're investing in a company. You're investing in a company that is listed on the stock exchange. E.G. Apple, BP, and Microsoft. Indices is a indices tracks a group of shares, isn't it? Tracks the price of a group of shares. E.G. S M P 500. Currencies, also known as Forex, which is also known as Forex or FX. Currency markets. See the buy and selling of the world's currencies, commodities, our physical assets, like houses that are consumed or used by people. Assets that are consumed by people. Animals and industry. Notable examples include oil, gold, and oh, never mind, not houses. E.G. Oil, gold, and wheat. Animals and industry. Right, okay. What affects the markets? Each asset will have its own. So each of these will have its own unique factors that affect its price. But every market's price is driven and formed by the fundamental principle of supply and demand. Demand is how each asset has its own unique factors which affect its price. But every market is driven. Price is driven first and foremost by the fundamental principle of supply and demand. Demand is when people try to buy a financial market. If demand from market is low, supply is high, the price will drop. That's how many people are trying to buy a natural market. If the demand is low but the supply is high, the price will drop, isn't it? Yeah, the price will drop. If the demand rises but supply doesn't, the price, so if the demand rises but the supply doesn't, the price will usually rise as well, isn't it? Yeah. Cool. Supply is how much of a financial market is available for purchase. Much of the financial market is available for purchase. If lots of people want to buy something but supply is limited, the price will rise. True. If lots of people want to buy something but the supply is limited, price will rise. If supply then rises but demand doesn't, if but supply is limited as price, if the supply then rises, so if there's lots of things now, price will usually fall. Right, okay, if the supply rises but demand doesn't, the price will usually fall. Demand. Demand is how many people are trying to. Wait, this is already written. What the hell? Okay. Lots of things can cause the supply to fluctuate for an financial market. Can affect the supply of a financial asset, not market. For example, a large shareholder in business may decide to sell all their stock, flooding the market of shares and causing their price to fall. Oil supply, on the other hand, is dependent on a wide range of companies used around the globe. A large shareholder in a business may sell all their shares, which increases the supply. So if the supply increases but demand doesn't, the price usually fall, which increases the supply. Causing the price to fall. Oil supply, on the other hand, is dependent on a wide range of companies and users in countries around the globe. Oils, the other hand, is dependent on a wide range of companies, institutions, and countries around the globe. So oil supply, on the other hand, is how much is available for purchase. How much oil is available for purchase around the world. On the demand side, a few important factors to watch out for include. So this is what to watch out for. Lots of things can affect the demand of a financial asset. E.g. News. As many market participants keep an eye on the news. In real time. Positive or negative headlines affecting the market can quickly drive supply or demand up and down. Central bank policy, central bank decisions such as interest rate. central bank decisions such as interest rates can have a profound effect on the flow of money around the world. So this is the bit where we read about earlier, I think. So if an interest rate in one country decreases, and the trader might sell it and then buy a put it in a bank with a high interest rate in another country, so the money gets moved about loads. Demand. Company results. Companies listed on exchange. Will release result, which will encourage investors to buy or sell their share, So they will want to increase or decrease the supply, isn't it? The supply. Because using that example as above, if they did sell all their shares, then the price into fall. Okay. Government data. Government releases such as unemployment information or inflation data offer insights into the strength, into the economy strength which may make it more attractive for investors. Okay. I think we're going to leave it here for today. Yeah, cool. Alright. Thanks for watching, everyone. Goodbye. See you next time.